Nothing runs like a deer, they say, and Deere is going to be reporting earnings this week, on Thursday, on the 15th. We're going to take a look at one of the better performing industrial stocks ahead of that report today on Open Interest. Hello everybody and welcome. I'm Mike Coe. Welcome to Open Mic. And John Deere, the company, of course, people are familiar with John Deere equipment, I'm sure. Those are the ubiquitous green tractors with the yellow and black. I'm sure everybody is familiar with those. I actually was looking around and hoped I had a Deere hat. I might have sported that ahead of this. The company is going to be reporting earnings this week, and Deere has long been one of my favorite companies. It's one of the oldest companies in the United States. It traces its history back to the first half, believe it or not, of the 19th century. John Deere, I believe he lived on the East Coast. He was a blacksmith. He moved, apparently to avoid some financial trouble that he found himself into, to Illinois. And he developed a self-scouring plow. And what that really meant was that he developed a plow that was relatively slippery for the earth to slide off of. So the plows that had been used up until that time, the dirt tended to adhere to its surface, so they had to be cleaned fairly frequently. This is my understanding. And so he developed a self-scouring plow. I think he released that in the late 1830s. And one of the other things that he pioneered was that he decided that it was a good idea to start building equipment, some of the agricultural equipment that he was making, not on a made-to-order basis, which was how things were done up until that time for the most part. So this isn't exactly Henry Ford assembly line type of stuff, but the idea was that he was going to have some form of inventory so that people who were interested in buying his products could actually come in and see what it was that they were getting, and he would have them available. Of course, here we are nearly 200 years later, and Deere represents approximately 60% of the agricultural equipment market in the United States. And also, about 60% of all of their revenues come from agricultural equipment. And the reason I mention that is because, of course, for the other smaller percentage, they actually would compete with heavy equipment and construction makers like Caterpillar. So that would be the business that makes excavators, backhoes, bulldozers, graders, and that sort of thing. So what is interesting here is that since the pandemic low, which occurred on March 23rd of 2020, John Deere has outperformed the NASDAQ by well over 50%. I think it was about 56% or so when I was looking at it as of today's closing prices, and outperformed the S&P, and this is on a total return basis, so net of dividends as well, by nearly 75%. So extraordinary performance. And I have here on my screen right now, my Bloomberg chart is a 5-year chart which kind of illustrates the performance that I'm talking about. Really pretty exceptional. And actually, I'm just going to put SPY in here at the same time so we can kind of compare how that would have done relative to the S&P 500, or proxy if you were buying the exchange-traded product. Something else you're going to notice, though, is that the stock has essentially been range-bound since the tail end of 2020. It really hasn't, I mean, obviously it has gone higher, it has been significantly lower. Lately, it has not seemingly traded all that well, and it was this recent performance which caught my eye because, like I said, this is a company I've long liked. I think they make good products. They've had a couple recent issues which are causing a little bit of angst. So Davenport, Iowa, which is where they have one of their manufacturing facilities, is going to be closing, and they've announced a number of layoffs. In fact, in total of the 83,000 employees that Deere has worldwide, their layoffs amount to about 2,000 of those. They're going to be opening up a plant in Mexico. And when I was just glancing at the company, I noticed that the thing was trading less than 12 times trailing earnings, I think. It was about that number, so let's take a look at that. Stock's 345. Last 12-month earnings, 32.44. Yeah, so we're talking about less than 12 times earnings. Actually, it's about 11 times, less than 11 times earnings, actually, on a trailing basis. So that looked incredibly cheap to me. And forward earnings estimates obviously were a little bit less, 25 bucks a share for the full year, 24 bucks a share for full year 2025. Their fiscal year ends in October of 2025. And I was trying to reconcile these two things. And as I did so, I thought this would be an interesting one for us to work through together. So just a couple quick things on the options market side. Options market is implying a move of about 6% or so after they report. That is larger than their historical move has been. Their last 5 earnings reports haven't been all that well received. So the last 5, the stock traded sideways or slightly lower the day after. And so as I began to think about that, I thought, okay, well, maybe what we need to consider here is why do the technicals look poor? Now, speaking of technicals, earlier today, and after I'd sort of formulated my thesis independently, I did reach out to my friend and CNBC colleague, Carter Worth of Worth Charting. And without giving him any kind of a primer on what I was thinking, I just said, what are you thinking about Deere going into earnings? And his response was that he would bet lower. I don't think he's published anything on that. This was, not some well-developed thesis that he came up with. He didn't send me a bunch of charts on it. I just said, give me your first impression. You look at that chart, because he's a chartist. I am not. But when I see that chart, it doesn't look particularly good to me. So how do we reconcile these things? When we see a situation where the options market is implying a bigger than expected move, where we see a company is trading at 11 times trailing 12-month earnings, 14.5 times full year estimated earnings for the coming year, that has been such a notable outperformance. How do we reconcile these things? Well, so 60% of their business comes from ag, 60% of all their business geographically comes from the United States. So my interest was, let's just take a look at the biggest potential drivers for Deere. Think about what those are, what those have been, how that explains what we've been going through, and how it might explain what we're seeing now. So this isn't trying to drill down into every part of their business. I'm not going to sort of get into the nitty-gritty, for example, of the 2,000 layoffs and the financial implications of those. There was a recent agreement that Deere reached because one of the things that was up in the air, and there had been a little bit of dispute, is that a number of farmers were unhappy with the fact that Deere was doing a lot of things that made it difficult, if not impossible, for people to perform repairs on their own equipment. And one can understand that to a degree because, of course, there's increased automation, increased electronics, increased syncing between these systems and GPS for positioning. They have sophisticated sensors so that they can figure out how many seeds are going in the ground and things like that. When they're harvesting, they can actually register not just how much they're collecting, but the moisture content of the grains that they're harvesting with their combines. And of course, an important development, which I think is going to matter a lot for the larger industrial farms. It probably will for the smaller owner-operator farms eventually as well, but that is self-driving technology. So you can see actually large farms in South America, for example, where a single John Deere combine is actually one of 5. The other 4 are essentially being led by one that has a human operator. And so, as just like if you can imagine, an airline cares a lot about things like fuel costs, personnel costs. If you can bring down your labor costs as well for what they call an operating engineer for equipment like this, obviously that's important. But the big drivers, at least in my view, for Deere during this big period, if we're looking at this chart, what was going on here that created this extraordinary growth situation for Deere, for their share price and actually for their profits too? Just to put things in perspective, let me see if I can, I'm going to try to see if I can put their basic income per share in here. There we are, basic earnings per share. So let's just take a look at this. This is a 10-year chart. Let's, how far back can I go with this? Okay. All right. So what we can see here is that the earnings per share were fairly steady and actually relatively flat, but growing fairly steadily up until we reached the pandemic. And then all of a sudden, they absolutely took off. Revenues shot up, earnings shot up even more. What was going on? This is my assessment. Basically, we had what I think is an agricultural equipment supercycle driven by three factors. Two of these are somewhat market driven, and one of them is policy driven. So what are the market driven factors? The two largest cash crops in the United States, which represents their largest market, is soybeans and corn. And let's just take a look at some charts here, first for soybeans and then for corn. And just so you're aware, as I bring up these price charts, these prices are reflected in bushels. Each futures contract represents, if my memory serves me correctly, 5,000 bushels apiece. So, and this price here, up in the upper left, you're talking about, that's essentially pennies, right? So that's $10.12 a bushel times 5,000 bushels. So one soybean contract, therefore, should be about 50,000 bucks. We can confirm that really quickly in case my memory is flawed. Yep, 5,000 bushels, $50,000 contract value. Okay, so I want you to look at this chart for just a second, and we're just going to work through a little mental math. It's not going to be too difficult, but it just helps give us some perspective on what was going on. So the price of soybeans was, pre-pandemic, in and around $8.90 a bushel. And it rose through the highs of 2022 up to as high as, I mean, you can see the all-time high was 1784. But let's, I mean, 1784, so that was an instantaneous high. I don't know that that's the best way to think about it. But, I mean, even if we took the average price, so we'll just take this 200-day moving average price and use that for the 2022 full year, that gets us to about 15 bucks, a little more than that, 15.5 bucks a bushel, up from, as I previously mentioned, you know, we'll call it 9. Let's do it this way. We're going to say $6 a bushel increase in the average price between 2019 and 2022. What does that mean for a farm? So in the case of soybeans, soybean farmers yield per acre probably about 50 bushels per acre. So if you get an increase of that magnitude, call it $6 a bushel, that's an increase on the revenue line of about $300 per acre. It should be mentioned that there were some input costs, some expenses for farmers that also shot up during this period. I saw, and again, we're going to use round numbers because drilling down to the minutia isn't what's important. It's sort of the big picture that matters. Fertilizer costs, we're going to say those increased on average by about $100 an acre. And those costs have subsequently gone down. So what does that tell us? Absent everything else, so just net of fertilizer, net of the average soybean price, that's an increase of about 250, you know, call it 200 bucks an acre if you want to work like that. $200 an acre for soybeans. Corn, so the yield per acre on corn is much higher, between 150, 200 bushels an acre. Call it, you know, we'll call it 180, something like that. So now we're going to take a quick peek at what happened to corn prices during this same time frame. So let's just take a look at that. And this is the, you know, one of the drivers that I'm referring to. It's not the only one. Oops. Number one, am I looking at corn? I am looking at corn. Ignore what I typed up there, but this is corn. Okay, so corn was running in the neighborhood of $3.90-ish a barrel. Just round it, call it $4. $4 a bushel in 2019. 2022, round numbers, we're going to call it $6.80. So we'll call that an increase of $2.80 a bushel. $2.80 a bushel times 180 bushels. You know what? Just, round numbers, whatever. We're going to call that, what the heck? We'll call that $500 an acre. Less 100 for increased fertilizer costs, net 400. That's a meaningful gross profit increase on the farming side. What else was going on at this time? Well, something else that was going on during this period of time, which is also quite important for this, is rates. Okay, so rates hit all-time lows, essentially, during this pandemic period, right? 2020, 2021, started to bump up in 2022. Notice, by the way, that the revenue side, the gross profit side, was increasing up through 2022, but John Deere had essentially leveled off a little bit earlier. But so you had very low interest rates. So put these two things together. These are a real push for farm demand for new equipment because you have much higher than average gross profits and you have very low financing costs. There was something else going on. We had a pandemic. There were supply shortages. A lot of things shut down. So there was basically very little inventory, which meant that you didn't have to create any incentives. You could boost your margins. All of these things are good if you are in the equipment selling business. So what was the policy portion in all of this that I was referring to earlier? So what do we have of the three things I just mentioned? High crop prices, which basically created even net of the input costs of things like fertilizer, high gross profits for the farmers, low interest rates, which encourages borrowing for investment in new equipment. The final piece in all of this is tax policy. And the tax policy I'm referring to are things like, and it's not the only one, but things like the Section 179 deduction. So for any of you who happen to run a small business or run a business at all that involves the purchase of equipment, this is something that you're probably familiar with, which is that when you purchase equipment, how you depreciate that equipment matters. And it can matter particularly for businesses where the revenue side is highly volatile. And where you can't really push your profits and losses that easily forward and back. So I imagine most farmers are probably operating as C Corps, and you probably have some other, subchapter S corporations and so on. But just to keep things simple, using Section 179, it is possible to depreciate new equipment purchases, in some cases, all in the first year, the year that the equipment's put into service. So you can imagine that if you are a farmer who suddenly sees an uptick of $750,000 in your gross profit, and you have a couple aging combines or other equipment that might be due for replacement, probably you didn't have to replace it right then, but now you have a real incentive to do that because you can depreciate all of that the year it's put into service. And of course, it's a fair treatment in my view because you experience very volatile earnings, so you might have big gross profits one year, you might have no profits or losses the next. But that accelerates the purchases. So this created, to me, a super cycle of sorts. And as I look at that, I began to understand why the stock trades so poorly when the multiples are so cheap. And this is one of those things that I thought this was kind of a good and important teaching moment because, people use screeners and they say, oh, I want to filter for stocks that have low PEs. And, this one has a very low PE. It has a low forward PE. So we often try to look out to forward earnings multiples and say, well, the trailing PE doesn't matter, which is true. You're not buying what the company did. You're buying what it will do. And so you look at it and you say, okay, 14.5 times forward earnings. That looks pretty good. But what's the catch? Well, the catch is this. The catch is that this assumes, and we're looking at pretty big revenue decline estimates year over year, right? So they're forecasting for October 31st, 2024 year end, fiscal year end, year-on-year revenue declines of about 26%. And that's a pretty big decline. Is it big enough? Well, we'll see. The following year, they're not really forecasting much. They're sort of expecting flat sales. What's important to me, though, is take a look at these margins. So they're forecasting 15.4% margins for the full year, 14.5% for full fiscal year 2025. Let's go back in time a little bit and see what their margins look like historically. Well, lo and behold, during other periods where we experienced rates that look like this, where we saw crop prices that look like this, those margins were not 14, 15%. Those margins were 7 to 9%, essentially half. Well, I'm not saying that's where those margins go back to, but if they did, what would things look like then? Well, if next year's margins went back to a number like that, let's just say that you trim 550 basis points off that number. Suddenly that forward multiple doesn't look like 14.5 times. Suddenly you're taking a look at not 24 bucks in earnings, you're looking at 16. Well, 16 bucks a share in adjusted EPS, the company is trading at more than 20 times that number. In fact, at that number, it's actually trading at a premium to the S&P's multiple. And supporting this a little bit is also the fact that used tractor, agricultural equipment inventories have been going up. What also got me thinking and looking at this is I took a cross-country drive this year. I drove through Iowa, I went through Nebraska, Wyoming, Utah, I went through parts of Illinois, and so on. And the first thing that occurred to me was, my gosh, look at the prosperity out here. And one of the things that I talked about, in fact, actually one of the people producing this very live stream was on the phone with me at times, and I said, just take a look at the equipment that these guys are operating out here. And you could sometimes, close to the highway, close to Interstate 80, you could see dealer lots with shiny new combines and all that. Well, the used inventory is starting to build, and used inventory prices are starting to fall. And that is not supportive of new equipment sales. For one thing, in many cases, you have to dispose of your old equipment to purchase the new. You're not just going to fill your farm up with combines from every era. It just suggests slacker demand. So the combination of higher rates, the combination of all of that pull forward in demand, the combination of the accelerated depreciation that I'm sure a lot of farmers took during these sort of fat years, I'm wondering whether either the top line estimates are reasonable, the margin estimates are reasonable, or both. I think honestly both could be a little bit tricky. So we have a little bit of read through we can get from two competitors. Those two competitors are AGCO. So for those who don't know, AGCO is the company that owns, among other brands, Massey Ferguson. So for those who are in the Farm Belt or know anything about it, you may be familiar with Massey Ferguson equipment. Now this company did not see the kinds of sequential declines, but they also do not do the bulk of their business in the United States the way Deere does. And another one is CNH Industry. And I happen to be familiar with CNH Industry, or know what CNH Industrial probably stands for. And the reason was that, among other things, when I grew up on a very, very small, modest farm, but we did have a Case tractor, and the haying equipment that everybody always aspired to, at least in the area where we lived, was New Holland. So CNH, Case New Holland. And this one also has seen sequential declines, but also doesn't have quite the market share. You can see that they're forecast to have top line declines in the same ballpark, but I'm not as familiar with the tax treatment overseas in European countries. And of course, if you're looking at this and you say, okay, well, what is it in Europe? I'm sure it varies from country to country, from place to place. But anyway, this is the reason I believe that Deere is trading as poorly as it is. Okay, so what to do then? Well, first of all, if you have, I normally don't advocate selling calls going into earnings. I've mentioned this before, that earnings are one of those situations where you get new information, and that new information very often is some of the most important stuff that you're going to get as an investor. That said, it's probably pretty clear from my comments that despite the fact that I love the company, I love their products, I just don't love the market that they're in. And that's, generally speaking, a tough one to battle. Just can't, you have to live in the world you're given. So what I was thinking was that rather than selling a call against stock that you own, one thing that folks could consider is selling a call spread. So selling a call spread, we'll just use a simple example. And I'm just going to put this in here. So I'm just going to say, we're going to look at September regular way. This is for illustrative purposes. But I had been looking last week at the 360, 370 call spread. That was about $3.20-ish cents, I think, when I was looking at it last Friday. 317 now, so the stock actually traded down today, so that probably has something to do with it. Don't want to sell those call spreads for much, less than 30% of the difference between the strikes. So in this case, 370 minus 360 is $10. You want to get better than $3 for it. But I think this is a way that you could look to collect a little bit of yield. I mean, look, if they blow the doors off of it, it's not going to be the end of the world. But I just, you're still going to be collecting, give or take, about 1% of the current stock price. The worst downside risk to doing this is 2%. Just doesn't seem to me, though, that we're likely to get really good news out of them. It's possible, but I don't think so. I also think there's possibly some political fallout that could result from the layoffs. It's been getting a little bit of play in the media, I've observed. Made in the USA, employing U.S. workers, all of that sounds great. And then you start opening up a plant in Mexico, and they have somebody who's worked at a Davenport, Iowa Deere plant for 20 years up there talking about they don't know what they're going to do next. It's not a great look. Although the issue where they're able to work on their own equipment, the farmers can work on their own equipment, that one is not positive for Deere earnings, but it is good for consumers. It is good for the farmers. So anyway, that's a little walkthrough of what I was thinking going into Deere earnings. I hope you find that interesting. Okay, so with that, I'm going to just bump over here and take a couple questions for those of you who posted them before we got going. I appreciate that, even though I had a different topic in my mind. I'm always happy to lend my 2 cents to some of these other things. Okay, so Bob asks us, can you please help us understand the correlation of stock buyback programs and the blackout periods? Example, Apple's rally in June impact on their buyback, Micron Technology's buyback reinstated last week, and the blackout. Okay, so let's talk about the blackout first. Companies generally suspend their buyback operations around the time that they're going to be announcing quarterly earnings. Personally, whatever the legal implications of this are, I don't personally see that that's particularly important. The company, if they're initiating a buyback, I don't know that they should be second-guessing valuations. If they just had a consistent program, that would be fine with me, but that's not actually the way it works. So they generally suspend their buybacks a couple weeks prior to a couple days after their quarterly earnings results. So let's talk about Apple first. So this is going to show you this chart on the left here. If you can see this, I'll try to take a little bit of time and make sure that my chart is being shared with Y'all, okay. You should be able to see this. Let me see. Does this blow this up? I think, maybe not. Okay. So this represents the executions in the number of shares purchased, and you can see that there are a couple holes in it. Now, bear in mind that these monthly executions, because they won't necessarily suspend the buybacks for an entire month, you will sometimes see that reflected as a smaller than average buyback. And then over here, we can see the volume weighted average price. So obviously, companies buying back their shares is supportive of the stock's price. It's supportive of the stock price in two ways. The first way is probably fairly obvious. You introduce a buyer into the market. Share prices are driven at the margins by incremental supply and demand, creates additional demand for shares, drives the share price up. The other is a more fundamental one, of course, and that is it's accretive, right? So every single share, as they buy back shares, every share you own represents a larger portion of the company. So its share price should increase. Whether buybacks should be encouraged, whether that's the most effective use of corporate capital, is a separate question. Personally, my preference would be that they did not tax. This may seem rather incredible, but I don't think there should be double taxation. You should not tax corporate income and then tax distributions. My own take is that if you are concerned about taxing corporate income, tax corporate income and don't tax the distributions, or alternatively, you could say we only want to tax distributions. And then they would be taxed according to the tax rate of the recipient. Why would that matter and what would be fair about that? Well, if you had, and we do that to a degree, we have something called qualified dividends, but the idea is that if you had tax exempt participants like pensions and trusts, that this would help bolster their finances, which is a common good, we could argue. And there would be a measure of fairness, which is that you would be subjecting the distributions to the appropriate rate of tax for the recipient. Corporate income taxes don't do that. Otherwise, I might favor that you have a relatively lower sort of top-line corporate income tax level, one that would make us competitive globally. We saw that Ireland did this. We saw that that attracted a lot of industry. So, I mention that simply because we have it bandied about. Whenever there's this perception that, these wealthy corporations. Well, what are wealthy corporations? Corporations themselves aren't wealthy. The corporations are just legal entities. What you have are shareholders. That's really who pays the price when you decide that you're going, to tax, how much you're going to tax, how you're going to tax. And so it's easy to sort of label a corporation because it's not a person, even though from a legal perspective they are treated as such. And so it's sort of the same thing. That was a little bit of a sidebar on this whole topic. But you will see that the increase in share purchases should be supportive of the price. You will see that it should be fundamentally, and you can see that oftentimes that's represented in sort of the share price, but not always. So reason to buy? Sure. Timing? It's going to be difficult because you don't know what their open market activities are going to be until after the fact. You can try to handicap them. You know it's not going to happen into earnings, but we have that other issue, which is that earnings is going to be when new information is generally released to the public. So you have to make your determination and should make your determination about whether or not you want to buy the shares going or continue to hold the shares or fade the shares, maybe in the case of John Deere or whatever, going into earnings independent of that. That's my thinking. But yes, you can track it and you can see how this goes and see all of that. Okay, so PC asks, how do you support resistance in constructing option strategies? Should call sold be slightly below or above resistance? At to slightly above. It's a really good question. I hope I'm sharing that on the lower third so everybody can see this because this is important. I use that actually quite a lot. And maybe we can, well, I wonder, let's see, let's just find another name that's, this is, whatever I'm going to be looking at, by the way, this is not necessarily something that I've looked at, but we're going to look at it together with fresh eyes and see what we can see. So we'll just take a look for some names that are going to be reporting. Today's the 12th. I better make it 14 days because if it's, you know, for example, tomorrow pre-open, that's not really all that helpful. What do we got? ConAgra. Oh, there we go. Yeah, we mentioned this. We got Tapestry. That's kind of an important one. Applied Materials, Palo Alto Networks. Why don't we look at Walmart? Walmart, really important look into consumer sentiment. All right, so we'll just do the same things that anybody probably would normally do. What's the first thing anybody does when they're thinking about it? You look at a chart. Okay, so here we have a chart. You don't have to be a technical analyst to do this. It's just instinct. Everybody wants to know, okay, what's the price doing in the near term? This seems fairly constructive to me, just at a glance. Okay. What's the options market implying for their move? Implying about 5%, give or take. On average, done pretty well historically over earnings. Okay, so far, so good. What are we looking at in terms of multiples? So we've got full year estimated earnings at about $2.44 a share on 68.70, growing at 10%. 10% forecast EPS growth for next year as well at about $2.70. So valuation relative to growth, so the price earnings to growth ratio does not seem bad. Diversified, touches everybody and everything. This is interesting, and that is that on a 2-year historical basis, it appears that their multiple is higher than it has been. So this is a 2-year number. So these orange little triangles that I'm highlighting here, these represent the mean multiples over the course of the last 2 years. So forward price to earnings, on average, the company has been, trading right around here, and we can see that it's actually trading at a pretty significant premium to that. So yeah, 25% premium. Let's expand this a little bit. It's probably not going to make much of a difference because, of course, a lot of things traded cheap during the pandemic, so that's probably going to throw these even more. Yeah, sure enough, it's not really making that much of a difference. But it's trading basically at a premium to most multiples, whether you're looking price to book, you're looking EV/EBIT, price to sales, probably. This doesn't actually reflect price to sales, but we're going to take a look at that in just a minute, and price to earnings. But there is some justification for this. I will just quickly add that the company is, or has, I should say, over the course of the last couple of years, seen some top-line growth. You can see that in here, 6 to 7% top-line growth, and that's after pre-pandemic they had a couple of years where there really was very little to no growth. They weren't even growing the top line at the rate of inflation, let alone at or above the rate of economic growth for the country more generally. And now we're at that point. The company does seem to be growing the top line at nominal GDP growth rates or better. So we've got a situation where we could say, all right, some of these things are supportive of a bullish case, and at least one of them is not. The bull case is they've been executing well, the grocery business has been doing well, they're growing the top line or have been more recently at faster than nominal growth rates, decent price earnings growth rates, so price to earnings of mid 25, 26 area on 10% year-on-year growth. That's all good. The problem is that it is trading at a premium to its historical multiple. So you look at that and you say, okay, well, I want to own upside. I want to mitigate the risk, so I'm going to buy a call spread. And this is where we start talking about resistance and things like this as you're talking about. So we can see that actually OptionPlay's own scoring mechanism right now doesn't seem to be overly optimistic. Once again, more supportive of an option structure if you're thinking about making a bullish bet going into the event. So I'm once again just going to back up to September regular way and say, okay, where are the areas of resistance? Well, if I'm making a bullish case, I'm probably looking for more than 2% to the upside. But we have resistance supposedly around 71.33. That actually makes sense because that's the all-time high. So I might say there's two things I can think about here and two plays I can make. One, do I think that's resistance? And if I did, the trade then, and I'd probably have to use weeklies because I need to get the strikes a little bit closer together, and I can probably get dollar strikes if I move into a weekly option, so we'll do that. So in that case, I would try to take something at or just out or slightly in the money. So that would be either the 68 or the 69 calls. Let's just take the 68s. So just barely in the money. I'm going to buy those and sell something that's just out of the money outside of that upside like this. So that upper resistance area. So this would be one thing that I would do if I was looking to get close participation with respect to taking a look at support and resistance levels. Okay. But there's another way that I actually look at this too. And the other way that I look at this is, okay, well, I'm not really all that excited about $2 or $3 worth of potential upside in Walmart. What I'm interested in is whether or not the company actually can break above that resistance, which is a whole separate thing. So another way to play this, and this is going to depend a little bit on your thesis, but if you believe that that's going to present an opportunity for the company to break out to new all-time highs, then that is arguably the strike that you should choose. At or just above the resistance level, playing for the breakout, right? So how might something like that look? Well, in that case, I'm actually going to be purchasing the call essentially at or just above that resistance level. Now, I'm looking to October regular way. That's only a 30 delta call. But in that case, I might be looking at something like this. So I'm risking a tiny fraction of the current stock price, $1.30. So a very small percentage of the current stock price. And what I'm doing is I'm just playing for that potential breakout, playing for the opportunity that might be presented if the stock actually manages to get to and then ultimately trades through its all-time highs. So that's how I like to look at support and resistance levels. So one, I'm playing for it to hit that resistance and fail. And the other is I'm looking for it to actually break out of that resistance. So I hope that helps. And again, we just picked a name out of a hat because it's a big and important one. And I think that was kind of helpful. So Kirk asks, I follow the put-call ratio for 10-year to year ratio on the S&P and the VIX. I'm guessing that this thing spit out VIX, V-I-C-K-S, like VIX Pharmaceutical, as a spell check or something like that. And by the way, for anybody who's looking at this, Kirk saw that and corrected it immediately. It said VIX as in VIX index. But I thought it was funny to put it up there because that kind of thing drives me nuts. I can't tell you how often I'm trying to type something and spell check throws something out there that was not what I meant at all. I was talking about something recently in a text and I put nearly, and I was just blowing through it. I looked back and it said gnarly, a word I never use. I never say gnarly. And so I had to follow up and say I didn't mean gnarly. Also, spell check, for whatever reason, on my phone for the longest time said yo, as in yo, what's up? Yeah. I find that impolite. I don't like to say yo to people. And yet, for some reason, autocorrect would throw yo in there all the time. Drove me absolutely insane. I don't pay that much attention to the put-call ratio, to be honest. We talked about this a little bit on the most recent live stream. That was a traditional approach historically. But, it gets it's very noisy. When is it noisy? It's noisy close to expiration. Have a lot of open interest, got to roll over. Is that meaningful? Not really. VIX, on the other hand, is a real-time indication of the variance implied in S&P 500 prices. So to me, whether you happen to agree with it or not agree with it, it's sort of the best sentiment, broad market sentiment indicator we've got, I think, at any moment. It's sort of, where the meeting of the minds take place. The market makers, the speculators, the hedgers, the bulls, bears, everybody sort of lands in there, and that's where the options prices landed. And I kind of like to use it for that reason. It's kind of like the best guess, the wisdom of crowds kind of thing. That's the best guess that options market makers on the SPX index have currently. And it's really not just the SPX because, of course, it gets arbed out between SPY and everything else. So VIX, my preference. So 10s, 2s, if I didn't share your subsequent message here, 10s, 2s is important, of course, not so much as a short-term technical indicator, but as a recession indicator. We had an inverted yield curve for the longest time, I think one of the most extended periods. Inverted yield curves are typically viewed to be indicators of a potential recession. And in many cases, the market doesn't soften. It's not just me that sort of looked at this, but oftentimes you will find that it isn't until the curve actually normalizes and so comes out of that inversion situation, so it steepens, that oftentimes you get a situation where you have basically the recession is sort of known, if you will, and the market's starting to feel that fallout. It makes good sense too, because think about this. The short end is the part that the Fed could, in theory, control the entire curve. They could just print, right? Aggressive QE at the long end will bring the long end rates down and bond prices up. But on a policy basis, using things like Fed funds and so on, it's the short end that we're really talking about here. If you have a situation where folks are expecting things are starting to slow down, unemployment starts to tick up, they're going to try to do something about it. What are they going to do? They're going to lower rates. So we saw that start to get baked in. The front end of the curve starts to come down. And as the front end of the curve starts to come down, especially if it comes down very aggressively, then inflation expectations and future growth expectations go up, right? That's the whole idea. You're trying to stimulate the economy. So that's naturally going to steepen things. But that steepening is going to be occurring right as people are recognizing that that is the policy action that is needed. So in theory, that's when you're coming to grips with the fact that you might be in a recessionary period, right? Okay, so Jack Vickery says, love this whole topic, ag, underappreciated. Look, it's underappreciated. I think a lot of people probably wouldn't have recognized that Deere was so much better an investment over the course of the pandemic plunge lows and the present day than it has been. Outperforming the S&P by 55, 56%, 75%, outperforming the Qs by 55, 56%. This is meaningful outperformance. What is actually more interesting, of course, is that all of that outperformance occurred at that front end, and it's basically been dead money for the last couple of years. One quick thing, by the way, and this was just, I'm reiterating or paraphrasing what the guy that owns that Applebee's in Times Square said on Fast Money several months ago, which is people got to eat, right? So whatever you may think about, and combines eventually wear out. So whether somebody runs them 500 hours a year or they run them almost around the clock 2,000 hours a year, these things do wear out. They do get replaced. But that expands and contracts, and people will continue to eat, and they're going to harvest corn, whether the price is $4 a bushel or $8. They're going to harvest soybeans, whether it's $10 a bushel or 16. That's a fact. But it's going to have, I believe that the volatility of equipment purchases is much greater, I think, than people are properly accounting for. Huntington Bank shares. Michael Anthony talking about HBAN. Boy, when's the last time I don't think I've said Huntington Bank shares out loud. I don't know if I've actually said that name in a half a decade. I'd probably be surprised, frankly, if I did. So let's take a look at this one. Gap lower recently, doing a little bit better. What are we taking? So here's the part that I'm kind of interested in. Let's take a look at their balance sheet. This is the part I'm interested in. Right here, if I'm highlighting it and you can see it. So this is the amortized held to maturity securities. I've talked about this before. You know, there was a question, actually it's kind of related to this. Where was that? Did somebody have, I'm so sure. Oh, Kirk, sorry, your earlier question. So related to this Huntington Bankshare issue. Skipped right over this question. Good afternoon, Mike. Which instrument would you select for investing in bonds? I thought about 7 to 10 year. Is 2 to 5 better for the present time? Okay, so this is related to the conversation we're having, and it's related to bank shares, because when I take a look at these banks, especially anything that's outside of the money center, too big to fail banks, the thing that I'm very interested in are these non-realized or recognized held to maturity securities that have all been really clipped. So it matters a lot how much duration you have. Obviously, if rates start to fall at the long end, then you want to be long duration. Duration being the sensitivity of a bond's price to changes in interest rates. The longer dated a bond is, and the more forward those cash flow payments or coupons are. So a zero coupon bond, because all of the interest is paid at the terminal end of that, at maturity, when you get all of your money back. So that will always have more duration than something where you're receiving coupons along the way, and the longer dated it is, the higher the duration, right? So it's just the sensitivity of a bond to interest rates. And if we believe, as many seem to be coming around to the view is the case, that we're going to see the short end come down, well, that does not necessarily mean the long end comes down. So I would actually say that I prefer mid to shorter end in that scenario than I do the long end. And this is particularly true if lower rates at the front. If the Fed is trying to balance an employment nightmare and an inflation nightmare, and they're trying to split the baby, that's not great on the inflation front. And political pressure will be immense. I'm not saying they should bow to it or cave to it. Elizabeth Warren came out a week or so ago and was saying, oh, I think they should, lower rates. And, the last thing we need, and I don't care what side of the aisle you're on, the last thing we need is for what some might argue is already a perverted monetary policy process to be further perverted by the influences of politicians. That's just bad news. I don't care for it. But I will tell you this, that my interest would be at the shorter end of the curve. Yields are good. I don't see those going materially higher. And, you're not taking a lot of duration risk. So I like the shorter end. And that goes to the question that was also being asked about Huntington Bankshares, because if that is true, then banks that have more duration in their held to maturity books, they aren't necessarily going to benefit. So I don't remember exactly what the duration was for Bank of America, but I remember it was a pretty high number. It was like 7 or something like that, 7 to 8. And so that's not a great positive. And I'm not sure that that's super helpful here. Now, it does help in the following sense, that when you're taking a big knock on your held to maturity book, which are assets that you can use to fully collateralize at the Fed if you're a bank. The problem is that if you're using them, you could be paying a short rate that is actually higher. You could be in a negative carry trade. The good news is, if the short end of the curve comes down and you have these securities that are out there, you're not having your non-realized losses erased, essentially, if the long end of the curve doesn't come down. And I sometimes wonder what was going on in the heads of the guys that put these things on. But the good news is you can post those as collateral, and the rate that you're going to be paying the Fed will go down. And then you'll actually be able to initiate. So the capacity of banks to lend improves, even if they're not making the money back on their non-recognized losses on the HTM book, if that makes sense. I hope that sort of helps. That's the way I like to think about it anyway. So lower rates in general will be better for them. Will it solve those unrecognized losses? Not necessarily, but it does mean they can actually get into something better than that negative carry trade if they want to lend against those assets, which they can post. They can borrow 100% at the Fed. So they basically post that collateral, things trading 70 cents to the dollar, but they can post it at 100. And then if their short end rates come down, and they can lend that out with a positive spread, then that's good. But it's still not as good as the guys that don't have those unrealized losses, right? So that kind of favors the JP Morgans of the world a little bit more than it does them. And what did I do here? This is where I wanted to go. Okay. Oh, and yeah, and by the way, you know, he said that it looks like it has major support at 13 bucks. That was the. Well, let's take a look at the support question. So most will know that largely by default, because I'll tend to look at the 150, which I thought I had programmed into this, but it is not there. Not sure why. Oh, turn that on. Here we go. Yes, so the short version is, where is that? Let's take a closer peek. So that support level, boy, we're really, well, I would actually argue that that support level is probably a little bit higher, and we're toying with it. So kind of a critical thing here. I would say that if we fall below, call it 13 and a quarter, that would be a little bit troubling to me from the technical standpoint. I will point that out. So let's also just take a look at it on a couple other metrics. Let's just take a look at it on a price to book basis, which I think is oftentimes a better way to think about a bank. Usually 1 times price to book is good. 1.13, not bad. Has been a little bit lower. Again, recognize that you have to sort of adjust for, and I don't actually have the time to dig into this, but I will, if I get some time, I will try to take a look at it. One of the things you do care about is what are those unrealized losses in there? And you have to dissect that a little bit. And I actually have to go through that because like I said, I hadn't even uttered the name Huntington Bank Shares. I can't remember the last time I said it. I'll have to go through their financials and see what that HTM book actually really looks like before weighing in much more heavily, other than to say, I think 13 and a quarter. If it gets below that, okay. Spicy barbecue. You're making me hungry over here. I could go for some tasty barbecue. Can only eat that as long as my wife isn't home, because she's not going to want me to eat that. She knows I love to eat things that aren't good for me. What's that? Somebody just getting in my ear. Oh, yeah. Okay, so what do we have here? 85-108 short strangle for a 540 credit on Dell. Okay, so let's take a look at that. So first step, always, what's Dell price doing? So let's see how that looks. Short strangle trades, by the way, if you have the margin, that can be a really good way to do things. I know Carter does a lot of short strangles. If you have levels where you're interested in getting long or short the stock and want to get paid anyhow, it makes good sense to me. So I'm not going to advocate those for everybody though, because, and certainly not in every circumstance, because the habit is when people start selling premium, they often try to become yield chasers. They say, oh, well, I can collect 1% a month by selling these options on ABC. But if I go over to DEF, I can make 5%. And if I look at XYZ, I can collect 7%. That's a bad exercise, because very often those elevated premiums are elevated for good reason. So what is interesting to me about what you're doing here And I'm going to play with this chart just a little bit. And let's see, what did you give an expiration for this? August 30th. Oh, okay, so this is really short dated, which is also a good idea, by the way. So far, so good. I like that. So let's just take a look at what we have going on here. I'm going to draw some lines. Or I'm going to try to draw some lines. And ignoring this, this really wild session that we had in there. So I'll take that line. So we're going to just ignore that really big bump that we had. Draw another line over here. So that's going back to that trend. And then over here. So your short strangle. I got to get, you know what? I have more screens. I'm trying to run this really lean setup, but I'm going to try to do something. I'm going to bring some of my other screens back. 108. Okay. So let's take a look there. Oh, and of course, what am I doing? The most obvious thing in the world. Check the event calendar, whatever you do. So we've got earnings on the 29th. So you're selling the event. Does that make sense? So the average move is about 8.3, implying nearly 12. And here we see why. Take a look at these last 4 quarters. Down 18%, up 31, 32%, up 21%. So we've had some really big moves. That probably explains why you're getting so much for that. Nevertheless, we've got resistance, the first area of resistance, 108, which I believe is the strike you sold. Yep. And 85. So look at that. Okay, so you're playing right in and around that first level of support and first area of resistance. So in general, I think that's a good approach. The caveat I'm offering you, though, is that those areas of support and resistance, which are going to be, they're based on some trailing data, earnings are, that's the big event. And in this case, much more so than almost any other stock. I mean, the moves on average over the course of the last 4 quarters have been tremendous. So just bear that in mind. Okay. Well, oh my goodness. I don't know where the time goes. More than an hour of your time I have used to talk about all of this stuff. And for those of you who stuck around to listen to all of it, I really appreciate it. And thank you for watching, and hope you do all the usual things like subscribe, notification bell, which is important if I do what I did last week, which is something that was not regularly scheduled. Just decided we were going to do one of these things in the middle of the trading day, which I think is sometimes important, sometimes helpful. If we have economic news coming out, and I think that we want to sort of digest it collectively live, then we might do something like that. So if you sign the, click the notification bell, then you're going to be notified when I do that kind of thing. But for everybody else, and for those who decide to watch this recorded later, thank you all for watching. And I will see you here on Wednesday, 4:15 Eastern.